Today I was walking around South Beach and what do you know? Look who I ran into. My buddy Nick from Reventure Consulting. How you doing, my friend?
What a funny coincidence, Michael. How's it going?
I'm doing good, man. How are you?
I'm doing great.
You enjoying this Florida winter weather?
Oh yeah, can't beat it. Miami in January, it's the place to be.
Oh yeah, man. I'm glad you made it down.
Yeah.
You were up there freezing in New York for a little while.
I was.
Made the trip down to Florida.
Yeah, I can see why people come down here in the winter.
Oh yeah, it's beautiful. So let's talk about what's keeping this housing market afloat, if anything, because right now it seems like everything is falling apart when it comes to home sales, the amount of pending sales, how much people are paying for homes, everything like that. And obviously you're well versed in this, Nick. So what do you think's happening with this? Because I see one thing that's really keeping people getting into homes right now and still making deals are people are really going for these mortgage rate buy downs. That seems to be like a huge incentive for home buyers right now. And for anybody watching who doesn't know what that is, mortgage rate buy down is basically a temporary rate. So you get the house and they say instead of paying 7% right now, you'll pay 5% for the first year. Second year, you'll pay 6%. By the third year, you'll be paying the 7%. So on the surface, you get in the house cheaper, right?
Yeah.
At first, right? I mean, so it sounds like a good deal for some people that don't want to spend as much on the home payment. But, you know, we know how people are with money and they're budgeting for the first payment, not the payment they're going to have 3 years down the road. So
100%. So I guess like first things first, like, you know, the home, like you're saying, the home sales are down at the lowest level in a decade. Mortgage applications are down 40% year over year. But you're right, there are certain people who are still clearly buying. And I think you're right. In some cases, especially with home builders, these mortgage rate buy downs are really popular. The thing that concerns me with them is it's basically like a de facto adjustable rate mortgage, really. I mean, like, so, you know, the rate's normally going to be 6.5 or 7, and you get it for 4.5 or 5 for a couple of years, and then it goes up. You know, that's not technically an adjustable rate mortgage, but that's pretty similar to what a lot of people got into in the mid-2000s.
Right.
That really hurt the economy and the housing market. And so, yeah, that is a concerning trend. You're seeing a lot of lenders get more desperate in terms of like marketing their products and trying to get more loans out the door. And so you are starting to see more shady stuff, I guess we would call it, right? It's like some shady stuff going on in the housing market. And the other thing to know with an interest rate buy down, you know, if you get it from a builder or you buy a normal home, I mean, in many cases, you will be paying for that up front. Like you'll have to pay more up front to buy down the interest rate for 2 years, which is just you paying more up front. Now, in some cases, the seller will pay for it, in which case you wouldn't be. But that's another thing to think about. If it's an interest rate buy down that you're paying for, you're not actually going to be not going to be better off for it anyway. And so, but the biggest thing I'm thinking about with the housing market right now is the rock bottom buyer demand.
Yes.
I mean, we have not seen this low level of buyer demand since the middle of the last housing crash.
Isn't that something?
Existing home sales of 4 million annualized in November. It's going to be around the same level in December. And that's a big problem because back in 2006, that's exactly what happened in 2006 before prices completely fell into the cellar in 2007 and 2008. And so, yeah, Michael, things aren't good in the housing market right now.
Yeah, absolutely. I mean, we're seeing so many signs right now that just remind me of 2008, especially since, you know, I was a fresh new agent back then, and I'm starting to see all these same signs happening once again. But yet you have so many people out there that just keep saying, oh, don't worry, it's not going to be as bad as 2008. You know, everybody that got a loan over the last few years has the low interest rate. You know, they were well qualified. We don't have any of this subprime lending crisis anymore. There's not going to be a wave of foreclosures. I mean, what do you say about that?
Yeah, that's a really interesting argument. You know, I see people say, oh, low mortgage rates for so many years means that there won't be a wave of foreclosures or a wave of sellers, and that is so not true. And the way I know that, folks, is Fannie Mae, and you guys should look this up for yourself. Fannie Mae releases data each quarter on something called the debt-to-income ratio for home buyers who buy houses and get a mortgage. And what's crazy is that the debt-to-income ratio right now, as well as over the last couple of years, was near an all-time high. So even during the low mortgage rate environment of 2020 and 2021, debt-to-income ratio was still close to the same levels as it was in 05-06. And so what that's telling you is that home buyers, even if they have a low mortgage rate over the last couple of years, they were still very stressed when they bought the home. Either, they have other debt and other debt service payments that they're making on their credit card or student loans or something like that. Or, their income levels actually aren't as high as people think. And so I think this whole narrative that like we're not going to have a big foreclosure boom and that low mortgage rates over the last couple of years means that there won't be a foreclosure surge or a downturn, it's complete, excuse my language, BS. The data doesn't back it up. Additionally, I was looking at another data point today. Sorry to just keep rambling on this, but
no, keep going.
Closing LTV.
That's loan to value ratio.
Loan to value ratio. Fannie Mae also tracks this data. Closing loan to value ratio over the last 20 years, 25 years. The share of people putting less than 10% down, having a loan to value ratio basically above 90%, less than 10% down, is the same over the last couple of years that it was in 05, 06. So what we're saying here, folks, is that people who are buying, they're stretched on their ability to afford the payments, even who bought at low mortgage rates. Additionally, they bought with mortgages that were fairly highly leveraged, so there's not much equity. There's much less equity than people think, and we're already seeing that equity evaporate in a lot of different housing markets, especially on the West Coast, where prices are down 10 to 15% in just 6 months. And so,
absolutely,
yeah, I would be very cautious, guys. If you're a home buyer, a real estate investor, and you're getting spun like a bullish narrative, what I would do is actually ask that person, what were you saying about the housing market 9 months ago? And a lot of people who are spinning these bullish narratives now, they were saying 9 months ago that prices would never go down.
Right, that's
right.
They
were saying that inventory would never go up.
Right.
And there's a lot of goalpost shifting going on from the housing bull camp. And so be very careful if you're a home buyer, real estate investor, not to get tricked into making a mistake.
Yeah, absolutely. Because you know what? Like you just said, so many people basically just bit off more than they could chew when they bought homes over this last couple of years. Because if you think about whatever Nick just said, those debt to income ratios being what they are, think about this, guys. People bought a house that they probably paid over asking price for. Yes, did they get a low interest rate? Yeah, they probably did. But think about the car payment, think about saving for the kids' college fund, and all of this, paying for higher bills now that everybody's dealing with inflation. How do you think that's affecting people's monthly budgets? Even if they were a well-qualified borrower, if people are stretched basically razor thin, it only takes one emergency to basically knock down the whole house of cards for people right now.
100%. That's a really good point, Michael. And one of the metrics I'm actually looking at from a macro perspective, which I would encourage a lot of you to track, is the personal savings rate in America. This is data that you can look up from the Federal Reserve Bank of St. Louis, and it's measuring the amount of money that Americans are able to save from their income. And guess what it is right now? Do you know what it is? You probably know what it is, Michael. Do you know what it is? Personal savings rate percentage?
I think it's like, what, 2.4% right now?
He nailed it, 2.4%, exactly. And that's close to the lowest level of all time. And so what that low personal savings rate means is that, yeah, Americans don't have money. They don't have excess money to spend. They're really stretched in their ability to afford things after 2 years of record high inflation. And so that ties in perfectly with the argument you were making about, yeah, someone had a low mortgage rate, but they had all this other debt. Right. Well, additionally, they have all these other expenses as well. Food costs have gone up, and so there's just not enough money to go around. And one of actually my favorite data points that I've started looking at recently is something called the default rate. It's the percentage of mortgages that are in default at a given time.
Okay.
Now, right now, the default rate is very low because the government pumped all this stimulus into the economy and the unemployment rate is low, so the default rate's low. But if you go back to 2020 during the pandemic, the default rate went to over 8%. 8% of all mortgages went into default, which was close, almost as high as it was in 2009, 2010. Now, of course, those defaults did not end up as foreclosures this time because of the foreclosure ban.
The moratoriums.
But they happened, folks. And basically what we're seeing more and more is the default rate over the last 20 to 30 years is heavily correlated with the unemployment rate. So the reason that we don't have a lot of defaults and a lot of foreclosures right now is that the unemployment rate is low.
And what do we know about that? We know that the Fed is actively trying to make that number go up right now.
Right, so, which is scary. It's kind of scary how the Fed is almost like deviated from focusing on inflation now, and they're like targeting other data points, right? So it's like inflation's coming down, but now they're like, the unemployment rate's too low.
Well, that's their theory, right?
The wage growth is too high.
Yeah.
So we're going to keep going until we make sure those things change. That's a great point. I mean, I would imagine you think unemployment rate's going up, in 2023, right?
Absolutely. I mean, they said they wanted to go at least to 5.5%. Right now it's at 3.5%. So that's 2 more percentage points until the Fed is maybe satisfied with where it is, guys. Now, I don't know the stats on that. Maybe you know off the top of your head, Nick, like what the unemployment figures are right now at 3.5%. What does that mean in terms of how many people? You know how many people that is? Because I don't.
Who are unemployed?
Right.
Yeah, I think it's something like around 5 to 6 million who are unemployed right now.
5 to 6 million. So that number is going to easily go over 10 million if they reach their number.
Yeah,
that they want.
Exactly. And that's something where, look, one way to also zoom out and think about this, everyone. Right now, home buyer demand is at a 20-year low when we look at mortgage applications. Rental demand is at a 30-year low when we look at data on new lease applications. So with a 3.5% unemployment rate, we have the lowest demand to buy and rent homes that we've had in decades.
Think about that.
What does that mean, man, when the unemployment rate goes up? And it's like kind of a scary time. And one thing I would encourage a lot of you guys to look at is the rental market. Because I know a lot of you might be renting, looking to buy, right?
Right.
So you're looking at the for sale market, which understandable. But what's going on in the rental market right now is shocking. That we have rents now nosediving in certain cities. Rental rates are nosediving. Apartment occupancies are nosediving. And if apartment occupancy rates are now taking a nosedive, well, the people who lease apartments would be tomorrow's home buyers. So if rental demand is collapsing today, that to me is like one of the biggest indicators that proves that for sale housing demand, home buyer demand is going to continue to be low into the future, regardless really what happens with mortgage rates, is because the amount of renters in America is going down. So that means that the amount of home buyers tomorrow is going to go down. And so that's something, I don't know if you talked about it on your channel, Michael, but the rental crash that's happening across America right now is something that not a lot of people expected, but it's severe, and it's telling you that the housing market and the broader economy is going to get worse, and that we're going to have deflationary forces in 2023.
Yeah, we talked about this in the past because basically this is the trend that we saw. Whenever the pandemic hit, you had a lot of people want to move out, get their own place because they don't want to be near everybody. They want to be feeling safe, like they're not going to catch the virus, things like that. Well, now that that's all largely over with, people are now consolidating households, not only because they're not afraid of the pandemic anymore, but because out of necessity. People need to move back in with family just to be able to stay afloat. People are looking for roommates again to be able to make the rent or make the mortgage. You have homeowners doing house hacking, things like this, just to keep the lights on, because when you see the cost of everything basically double in just a couple of years, I mean, this is the only way that you can kind of stay in your home and not go homeless or be able to pay the bills. And so that trend is being completely reversed. Like Nick just said, when you're seeing the demand for even rentals go down right now, I mean, what does that tell you guys? It tells you that people can't afford things right now, is basically what it is.
Yeah, affordability. Basically 2 years of inflation just completely stretched budgets thin. People don't have money anymore. We're going to see that show up in the consumer spending data. But I think what a lot of people, what they ask me, Michael, I'm sure they ask you this too. They're like, okay, like I see the arguments you're making, but they're like, why isn't it happening faster?
Right.
You still look at home prices.
There's no crash
and
yet. Everything is still, it's all still expensive.
There's no crash yet, which in certain cities there's definitely a crash. But more broadly, it would be accurate to say across America's housing market, prices haven't crashed yet. They started to go down, but they haven't crashed yet. So people say, why? Why is this happening slowly? When is it really going to kick into high gear so you can look on Zillow and see a house that's affordable to you? And the important thing for people to remember, historically, housing crashes take time to play out. On average, they take 5 years. Not saying this one's going to take 5 years, but historically, that's what happened from 2007 to 2012. That's what happened in the early 90s during regional housing crashes that occurred then. That's what occurred in the 80s in different markets. And so it's a slow-moving beast. It's not like the stock market where a stock will just go down 40% in a day. And the reason is because housing is a very emotional. I'm sure you know this as being a realtor, right? Like a lot of people don't want to cut the price of their home right away, right? Like you might have advised a client in the past to cut the price, but they're like, oh, I saw my neighbor get this 6 to 9 months ago.
Oh,
I'm not
yeah.
going to cut the price. And can you just talk about that a little bit, kind of the psychological thing that's going on with a lot of maybe stubborn sellers, and why that means that housing downturns take a bit of time to get going?
Yeah, absolutely. When it comes to people's psychology on this, basically in my experience, it played out exactly like Nick just said. You know, you'll take a listing, and almost every single seller that I've worked with would usually want to price it high and then lower it later if necessary, because everybody always says when it comes to negotiation, you know, you can always come down, but you can't go up. And there might be some truth to that. But the problem with that way of thinking is when you're pricing your home 100,000, 200,000 above what the actual selling price should be, is not only is it a waste of time, you're not going to be able to sell, but also, you know, you really haven't caught up with what's going on in the market, because you can say your neighbor got this price, but how long ago was that? 6 months ago, when the housing market was still at its peak? You know, you have to look at things like this, and a lot of sellers are not caught up with that. And just like we talked about in a recent video, so many people look at the Zestimate on Zillow and they think, oh, this is exactly what it's worth. But you got to realize, guys, that that type of thing is an algorithm. It's not perfect. It takes into consideration all different types of properties that have sold in the area, not just the ones on your block or in your neighborhood, to come up with that figure. And a lot of times it's not very accurate. So,
yeah, that's
right.
a great point. I mean, so you think, you know, like the Zillow Zestimate could be even making this trend more exaggerated, right? Because now a lot of homeowners have instant access to what their perceived home value is. But what I think is interesting is what's going to happen on the other side. So, on, you know, in the initial stages of the downturn, the Zestimates are still high, and people still think, oh, I'm going to list high. But like what we're seeing in a market like Austin right now is the Zestimates are down 15-20%.
Right.
So then what happens when a seller, a would-be seller, all of a sudden looks at their house, and they thought it was worth 600, and now it's worth 470?
Well, according to all the people on the other side of the argument, Nick, they're going to say, well, they're just not going to sell then because they have the low rate. They're those people that don't need to sell. And maybe some of them are some of those people that don't need to sell. But like what we were just talking about a little while ago before we came on camera, is you're going to see a lot of people in a situation this year that need to sell, okay? That's the situation right now where it doesn't matter if you want to or not, guys. When people need money and that's the biggest asset, it's the first thing to go. Okay?
100%. And I think the right way to think about that, and look, you know, you're right, like, there are a lot of people who don't have a gun to their head and who won't be forced to sell. But here's the way to think of it, everyone. Inventory right now in the U.S. housing market is about 1 million homes, roughly, on the market.
And that's up, by the way, too.
That's up. That's up by like 75% year over year.
Right.
But the amount of total single-family homes is 100 million. So currently inventory is 1% of all homes. The amount of investor-owned homes is 20 million. The amount of second homes is 5 to 6 million. In addition, we have a lot of senior owners who basically don't have money and whose entire net worth is tied up in their house, who are going to need to sell this year. They're in the millions. And so you actually only need a very small share of distress, to all of a sudden double inventory in the U.S. housing market, which is something that I think could happen in 2023, seeing a doubling of inventory. And so that's the way to think of it. It's not as if everyone is going to be panicked and distressed. It's we only need, you know,
a million. We
only need one out of, a million. We only need 1 out of 10 or 1 out of 20 to feel distress, and there it goes.
Right.
And so it's very much a market at the margins, the U.S. housing market. And one point I want to address is the psychology. Back to the psychology. The number of realtors in America. 1.6 million realtors. Why am I bringing that up to you guys? Because the number of realtors in America is still at a record high. 30% higher than the last peak in 06.
Wow.
1.6 million. Now, home sales are at close to a 20-year low. But the number of realtors is still at a record high. And so the number of home sales per realtor is at a record low, 2.6 home sales per realtor per year. What that means is that realtors aren't making money. Many realtors are making no money, but they have not quit yet. That's a good parallel for kind of the psychology of sellers, maybe the psychology of certain investors, where a lot of them aren't making money, don't have money, but they haven't quit yet because it takes some time for people to get over the cognitive dissonance of understanding the reality of the situation. A lot of realtors are going to quit. A lot of sellers need to unload their house because they don't have money. A lot of investors are going to need to unload because they're going to get margin calls from their banks. And so I would encourage a lot of you, watch that data point, the number of realtors. It's updated every month from the National Association of Realtors, because what I predict is that as you see the number of realtors go down, which has started to go down a little bit, that will be the analogy, the parallel to explain when the sellers come to terms with reality, when the investors come to terms with reality. As you see those realtors quit, you're going to see inventory on the U.S. housing market surge. You're going to see prices go down by even more. And so I just wanted to address that. And so you're still a realtor, is that right?
Sort of.
Sort of. But you still have your license, right?
I do.
Yeah. So I think we're going to see a lot of people give up those licenses. I don't know what you think about that.
Yeah,
But,
absolutely. You know, listen, I started my career right during the last housing crash. I got my real estate license in March of 2009, so prices were well on the downturn then. It wasn't even the bottom yet, it was on its way, but prices were falling. And I remember I was like one of the youngest new real estate agents in my office, because I was only 21 at the time, guys, so very young for real estate. Everybody else in the office was like mid-40s, basically. And I saw so many people quit and never come back, because what happened was a lot of these agents were basically living on this notion that it was never going to go down. You know, people thought that they were going to continue making all this money forever, spending like it's never going to go down. You know, I knew agents that were living off of credit cards once the sales started drying up back then, and they told me about it because, you know, I was young, I asked a lot of questions, and, you know, I was inquisitive. And basically, that was the story for a lot of people, and some of them never recovered. Some of them did, you know, were able to get financially disciplined like we talk about here on the channel, but some people never recovered, and those are going to be like the same people this time around that Nick is talking about. And I think also a lot of them are people that jump in at the last second thinking, oh, housing prices are high, I'm gonna, you know, make a killing. It's you know, real estate is easy money. That's the one thing that a lot of new agents think. And it really couldn't be further from the truth, guys, because anybody who's ever had to sell a house for a seller or work with buyers, it is not easy money, okay? It is in fact quite the opposite, let me tell you. And that's one of the reasons I'm here making YouTube videos with Nick right now.
Yeah, you're warning people from your experience.
Exactly.
And that experience is really valuable. I wish there's more people like you who were around. You know, I wasn't around actually, really. I wasn't working in real estate during the last crash. I look at it through the data perspective, so I know what happened. But I think, you know, to the people out there who, you know, saw what happened last time, maybe even saw what happened in the early 90s, you know, it's really important that you warn other people, right? Like it's happening. All the warning signs are here. It's already happening in certain cities. Like in Austin, prices are down 15% in 6 months. In Phoenix, they're down by almost 10%. Rents now in Phoenix are crashing, right? And those were cities, why I bring these cities up is because those were cities like Austin and Phoenix and Vegas where 9 months ago, everyone said inventory was low. Prices are gonna go up forever.
Right.
Literally in a span of 9 months, it completely flipped. And those cities are definitely in a crash right now. You can't argue that.
That's right.
And so what that means is if you're someone in Florida, if you're someone in Georgia, if you're someone in Tennessee, if you're someone maybe in South Carolina or in the Northeast, which hasn't really been hit by the crash yet, the Northeast, it's coming. It's coming. It's moving from west to east. And, you know, you better be prepared. And really, I mean, here's the upshot, right? Cheaper homes, cheaper rent. That's what's coming. That's what the fundamentals dictate is coming, and that's what's already started to happen. And so it's going to be a benefit to most of you out there. Cheaper homes, cheaper rent, cost of living is going to go down in terms of the housing market, and I think that's really the thing to keep your focus on.
Well, what do you say to these people? Because I see this all the time in the comments section. People say, oh, it's gone down by 10%. That's not a crash because prices went up 40%. So what do you say to those people? Because that seems to be the biggest counter argument to that.
Yeah, I mean, I would say tell that to someone who bought 6 months ago, first of all.
Who's already underwater.
In cities like Austin, there's like tens of thousands of people who are underwater on their mortgage. I know some of them personally. And so that's the first thing I would say. The second thing I would say is we're 7 or 8 months in. Give it some time. everyone.
And what do we say the average crash takes? 4 or 5 years?
Oh, it's fascinating. Guys, if you go back and look at what happened in 06, 07 in the lead up to that last crash, home sales plummeted, and then prices went down incrementally for like almost 2 years, actually. Like, there was lots of people in 07 saying what people are saying today. Oh, it's not a crash. Oh, prices are only down 5 to 10%. No big deal. And then wham.
Yep.
So really important to have that historical framework, everyone, because this is what I try to focus on my channel, is history, right? Because if you don't look at history, you're just gonna like buy whatever narrative someone tries to sell you in the given moment, right? Like someone could say, oh, 10%, that's not a crash, even though that person a year ago said prices would never go down. That person in a year is going to say 20% isn't a crash, and they're going to go all the way to the bottom, right? And then at the bottom, they're going to say don't buy. So
it's too risky. It could go down further.
It's too risky, and so like for me, the fundamental data is the most important. I look at the relationship of home prices to income, because we know over 100 years of U.S. housing market history, income is what fundamentally drives home prices, because that's what determines if someone can get a mortgage. That determines how much of a down payment they have. So I look at the relationship of home prices to income and home prices to rent. That tells me how overvalued different housing markets are. And I would encourage a lot of you guys to adopt this fundamental mindset. This is going to save you a lot of frustration and anxiety and confusion to develop a fundamental mindset on the U.S. housing market, so you can really see what's coming. And above all, figure out what your risk tolerance is, and when you want to buy. Do you want to buy at the bottom? Or are you good buying at a 10% decline and maybe seeing values go down by more after you buy?
Right.
Important that you understand that for yourself.
Absolutely. I couldn't agree more, Nick. I mean, I couldn't even said it better myself. I think your fundamental approach to the housing market in terms of, looking at the data, finding out what's happening within your housing market, because chances are it's probably different than what's happening a few hundred miles away, is going to be crucial with navigating this housing downturn and figuring out when's going to be the right time to buy for yourself. Even if it's too late to sell or not, some people, maybe they've already missed the boat, depending on where you live, guys. If you're in one of these markets,
If you're in Vegas, you might have missed the boat.
Yeah, or if you're in Phoenix, you're in Austin, places like this, you missed the boat. You're done. So
yeah, don't be that person in Miami or Atlanta.
Every single month, Fannie Mae, they track the home buyer sentiment index, and for last year it was kind of going down a lot, but an interesting thing that happened between November and December, it actually went up slightly. You had people going from 16% saying it was a good time to buy a home up to 21%. So ironically enough, during the holiday season, the home buyer sentiment actually went up for people. And I mean, what do you think is the cause of that? Obviously, we saw interest rates kind of go down a little bit during that time, but what do you think's going on with that?
Yeah, that's a good question, Michael. I think, prices have gone down a bit, interest rates have gone down a bit, so at the margins, I think there are some more people who think it's a better time to buy. The important thing to remember is, I think it's 21% now say it's a good time to buy versus 76% that say it's a bad time to buy.
Right.
So, there's maybe a marginal improvement in sentiment, but it's still horrible sentiment, close to a record low. And the other aspect of that survey I was looking at today actually was they asked people, do you expect prices to go up or prices to go down in the future? And for the first time in this survey history, I believe, or at least in like 10 years or 12 years since the last downturn, more people now think prices are going down than going up into the future over the next year. So you got to ask yourself, what is that going to do to buyer demand? If the sentiment starts to really become baked in that prices are going down, then that completely takes away any pressure to buy. The other thing I noticed in that survey was more and more slightly, there was a pretty sizable uptick in the amount of people who think interest rates are going to go down. A majority of people still think interest rates are going to go up, but now more and more people are thinking interest rates are going to go down. So I think we could get to this scenario soon where it becomes widely accepted that both prices and rates are going to be going down. And that's going to be very interesting, because if that becomes the sentiment, there's no pressure. It would be a bad idea to buy today, right? If you think prices and rates are going down in the future, which more and more people are thinking. And so, yeah, I think there's a slight uptick in sentiment from that survey, but reading into it, it's saying basically more and more Americans are catching on to the idea that the housing market is crashing.
Absolutely. Well, thanks to channels like ours, that kind of put out this information so people can get ahead of the curve. Otherwise, if you follow people like Mark Zandi, or you look at some of these other people who are like professional economists, things like that, they're never going to say the housing market's crashing. Only just now, they've been coming out over the past few weeks saying, well, it looks like we might finally see a small decline in home prices over the next year, but it's not going to be anything major. That's pretty much what they switched to, going from home prices are going to go up in 2023, because that's what they were saying 6 months ago.
That is what they were saying 6 months ago. I want to prepare you for another narrative shift as well. Very soon, there's going to be a narrative adoption that it's only certain markets that are having a housing crash. I'm already starting to see this kind of, it's like the ones we've been talking about, like Phoenix and Vegas and Austin. They're going to say, oh, it's only these cities, it's only the pandemic boom towns. And again, we go back into history, that's exactly what they said in 06. You look at Alan Greenspan and Ben Bernanke, heads of the Fed, they directly addressed the housing market back then. They said, oh, it's only small regional downturns, no big deal. And then, of course, it spread to the entire country. And so, it's really interesting to talk about like the narratives, like how the narratives move and how the goalposts get shifted.
Like you said earlier, so much of real estate is psychological, so that plays a big part in this as well.
Right. The psychological stuff impacts timing, right? Like, how quickly does it take for people to come to reality with the situation, or how emotionally attached are people to their houses, right? But in the end, fundamentals dictate where things are really going over the long run. And so, one of my favorite data points, super simple, inflation-adjusted home prices in America are still at the highest level ever. So even after 6 months of declines, the Case-Shiller Home Price Index, adjusted for inflation, is still higher than it was in 06. So we are still in the biggest housing bubble ever. So I guess to the point of the people who say there's no crash yet, we're still in the biggest housing bubble ever.
Well, that's what they look at. They look at that and say home prices haven't fallen, or the places that they have, it really hasn't fallen that much. So, it's nothing to worry about, basically.
Yeah. I mean, I guess there's two ways to construe that, right? To me, that says there's a lot to worry about. Inflation-adjusted home prices are at the highest level ever, walking to a recession, which in some industries is already here, in other industries it's coming. I'm actually curious what you think, Michael. What do you think about the recession? Like, would you say we are already in a recession? Would you say it's certain industries? Like, would you say it's coming in 2023? How would you describe it?
Well, I think that we're already in the recession. I feel like we've been in it basically since, the early third quarter last year. That's what I think, and that's just my personal opinion, and that's based on how we see everything going, right? You see all these companies starting to do more and more layoffs. You're starting to see the stock market tank, and the peak of the housing market was basically in June last year. When you look at Redfin's data, and really any other data set, like we talked about the other day, all of them show June was basically the peak of home prices, and now they are steadily coming down by a different percentage depending on which data set you look at. So to me, all of those things point to the fact that this is already a recession, but for some reason, today more than ever, it seems like the government just doesn't want to say the R word, right? I mean, that's like, they call it the R word now, right? You can't even say it, it's taboo.
And that's a little scary to me, is like, how they try to ignore it, because that says to me that, Fed, it's gonna keep hiking. Stimulus, it's not gonna come, because for the Fed to, change course and for stimulus to come, they would need to acknowledge the recession.
Right.
And so one fear I have is that they ignore the recession, and almost in the same way they ignored inflation. So, early to mid 2021, we had these signs that inflation was coming, right? It was starting to increase, but it was swept under the rug for basically 9 months. I feel like something similar is happening here, where these obvious warning signs. Housing recession, full-blown rental for sale market. The tech industry is getting devastated. The ISM manufacturing index is now in contractionary territory. And the Fed is still just hiking, right? And so, you could say maybe they need to do that because inflation is still high year over year, and you could make an argument for that. But it seems like we're walking into this scenario where the Fed is tightening money supply, increasing interest rates, when it's like there's these obvious signs that the recession is already here.
Right.
And look, maybe certain industries haven't felt it yet. I think if you talk to someone in leisure and hospitality who works for a restaurant or a hotel, they might not see the recession, right? Because like people were locked down during the pandemic, and people are still kind of getting all that out of their system in terms of going out and going to restaurants and things like that. But if you talk to someone in tech, if you talk to someone in housing who like makes their money off these things, and if you talk to someone in manufacturing, they'll tell you recession is here.
Exactly.
And so those are three pretty big industries.
One.
The yield curve right now, the difference between short-term and long-term bond yields, it's the most inverted it's ever been in relative terms. So right now you could buy a 1-year treasury and get a 4.7% return. You buy a 10-year treasury, you only get a 3.5% return. How does that make sense? How do you get 1.2% more for committing your money for 1 year instead of 10 years? And that's an inverted yield curve. And historically, every time the yield curve is inverted, we've had a recession, right? So that says we're either in a recession or going to have one. But what concerns me is how much it's inverted, right? 4.7 to 3.5%.
That's a big difference.
That's a big difference. And basically what that says is that the Fed is trying to push up rates, right? They're hiking short-term interest rates, so that causes the 1-year treasury to go up. But what's happening is they're not able to pass through those rate hikes to the long end of the curve. And the reason they're not able to do that is because institutions and banks and maybe countries, like they're starting to buy up long-term bonds because there's uncertainty. And in a recession, people buy long-term bonds, which pushes the yields down. So this is basically what the inverted yield curve really says is the Fed is tightening, which causes short-term yields to go up, just as like the financial markets are tightening, which causes long-term yields to go down. And it's the biggest inversion ever in relative terms, which says this recession is probably going to be pretty big. And I'd say that it's not to scare anyone, but it's just to lay out what the data is saying.
Right.
I also know a bunch of people like in more mainstream finance, not just real estate, people who work for banks and things like that. And when I talk to them, there's like this like disconnection. Like when I bring up the yield curve, they're like, oh yeah, but no big deal. Like they say things like there's still excess savings from the pandemic. It's like literally this data point has predicted every recession.
But somehow it's going to be different this time.
Right.
That's what it's different this time,
it's
right?
It's like falling back on like some weird, some narrative which might be true somewhat, but like, you're missing the big picture here.
Right.
The other thing is like consumer sentiment, right? Like consumer sentiment, University of Michigan survey. Worst consumer sentiment ever over the last 6 months. Like how people basically feel about their current finances and their future finances.
And you know what else, Nick? It's like so many people are banking on this fact that, interest rates are going to be lower by the end of 2023. Everybody thinks the Fed is going to pivot and rates are going to go down. Even mortgage companies, guys, get this. I got an email from a mortgage company a couple days ago that said, if you close on a loan with us before March 31st, then you can refinance with us by December 31st of 2023 with no lender fees, okay? So what did you say about that earlier?
So just to clarify, so you're basically saying you got an email from a mortgage company. They're saying, buy with us today at a high interest rate because we know rates are going to go down and you could refi with us later in the year. I mean, that's really interesting. What I said about that is it's basically a reverse adjustable rate mortgage where instead of getting a low rate today and a high rate later, you're locking in the high rate today on the off chance your rate might go down later. I mean, it's crazy. And look, I actually do think the Fed's going to pivot. I do. They always do. Fed always pivots. They've never not pivoted. It's the question is like, what's going to happen when they do? And when you look at history, usually when the Fed pivots, that's literally like what you would call the start of the official recession.
Right.
When the National Bureau of Economic Research goes back and says usually around when the Fed pivots is the start of the official recession. Stock prices historically go down for another 18 months after the Fed pivots. In the 08-07 housing crash, Fed pivoted in August 07. Home prices went down another 5 years. So what I take issue with is not maybe the notion that the Fed's going to pivot, but it's like people think it'll just save the day and that somehow like all these Americans who have no money because of raging inflation for 2 years are just going to be like, oh, the Fed pivoted. I'm going to go spend. Well, with what money are you going to spend with?
Right.
And so, yeah, Fed's going to pivot at some point in 2023.
But here's my problem with this. The Fed pivots, right? You said that they always do. And my issue with this is that we keep repeating the same mistakes over and over, right? They're going to wait until things are bad, then they pivot, start lowering the rates again. And what happened last time? They ended up lowering the rates to where it was basically at 0% for a long time. And that's what helped us get to this bubble to begin with, those along with the other factors that came along with the pandemic. But it's just like, why are they so afraid of a recession? Why are they so afraid of just letting things kind of fall back into reality and letting the economy kind of do its thing? Why do they always have to be doing this artificial, playing games and stimulus with things with these interest rates?
Yeah, it's true. It's true. And I it's funny. You could say like the Fed went from being way too accommodative, right? Like 0% interest rates and $5 trillion in money printing. So now I almost feel like they're on the other end of the spectrum, right? Like I think they're overcorrecting at this point. And the moral of the story is like the Fed generally doesn't know what it's doing, And I think maybe certain people might like Jerome Powell more now that he finally, stuck to like an inflation fighting mantra. And I like him more now because he stuck to that. But let's just not forget, the Fed is not very good at like nuance and subtlety and soft landing. They've never really done a soft landing before. And so, the fact that we went from like 0% interest rates and money printing to almost a 5% federal funds rate and contraction of the money supply in a year, that's pretty crazy. It's pretty scary.
Absolutely. And
we'll see what happens. My prediction, I'm curious what yours is, but so my prediction is like the Fed pivots sometime in April is when I think it's going to happen. They'll maybe do a small interest rate cut.
So you think they're actually going to cut the rates this year?
Yeah, I think that. So you're right. So the Fed doesn't think they're going to cut the rates this year. They're saying it's going to be above 5%. They're not going to cut all year. I think they're going to be forced to.
And why is that?
That's going to be an accelerated recession where we're really going to start to see the warning signs get louder and louder and louder. We're going to start to see the unemployment rate tick up. And that's going to cause the Fed to reverse course. And to me, the housing market is like the biggest warning sign, right? Like prices and rents are going down. Like the rent figure, right? Asking rents are going down right now. That's telling you that inflation 6 months from now is going to go down, right? The fact that asking rents are going down, and they're going down by a lot. And so, yeah, I think there's going to be an accelerated recession. It's going to kind of everyone's going to wake up to it pretty fast in the spring of 2023. And but maybe the narrative wise, they're not going to say that. They're going to say something like, financial conditions have softened and we're seeing deflationary forces, so we're just going to cut interest rates. They're going to say something like that, right? They're not going to be like, oh, there's a recession, everyone like run for cover.
Yeah, they won't say the word recession most likely.
No, but if you just look back at every recession, 2007, 2000, 1990. The Fed rate cut, that initial rate cut, is a signal that the next 2 years is going to be problems. And, that's just the reality of where we are. So I'm curious, Michael, what's your prediction? What do you think the Fed's going to do or not do in 2023?
Yeah, that's a tough one because I want to feel like that they are going to keep the interest rates high regardless of if there is a recession or not. But like you said, they've never really done that before. And, because they don't do that, because there's no history of them keeping the interest rates high when we're already in recession territory, probably Nick will be right. I hope that they do the right thing. And to me, the right thing is like I was saying earlier, why can't they just keep it high? Let's keep, the foot on the gas and bring things more back into reality before just, automatically reversing because now we're in the recession. So what, guys? That's how I feel about it. It's going to be a recession. It's going to be hard for people, but it's going to be bad for a little while and eventually it will get better. That's how I feel about it. And, if the interest rates remain high, then it's going to disincentivize another bubble from forming. That's how I see it.
Yeah, I think it's a great point. And look, I could be wrong. I think the one actually very interesting thing that Jerome Powell seems to have like earned everyone's trust. It's like very interesting to me that like he's able to just hike rates now and like no one really questions it anymore. right? And I don't really think he's going to get any pressure from Biden. Like, I think Biden's kind of checked out probably a little bit. Like, it seems like Powell's in charge, basically. Maybe on that side of the argument, he could keep hiking, right? It doesn't seem to be anyone that's telling him to stop. And so, you know, maybe he could be on this mission to reset everything to 2019 prices.
Yeah, absolutely.
You know? And maybe when you look at what he says, right, it seems more and more like that's what they're doing, right? They're now targeting the unemployment rate and the wage growth rate, not just inflation. So it'll be interesting. But yeah, just history tells me that the Fed's going to pivot earlier than people think in 2023.
So guys, you've heard it directly from Nick. Go check out his channel over at Reventure Consulting. He's been on a break for the last couple months, which is much needed, and he'll be back sometime in February of 2023. So make sure you're subscribed to his channel so that way when he puts out his next upload, you'll see it. I appreciate you coming on the show today, Nick.
Thanks,
it's been
Michael.
A pleasure, man.
This was fun.
Absolutely. So guys, if you enjoyed this video, make sure you click the bell notification down below. YouTube will alert you every time there's a new video. If you don't want to wait, check out the next one right over here, and I'll see you in the next one.